Hello and welcome to the third lesson of the introduction to the option market. In this case, we are going to speak about selling an option. So we are going to understand what we expect when we are going to sell an option, and at the same time learn how to navigate with the risk associated with the selling. We are going to see how to sell covered calls and cash secured puts. So, what is a covered call? We are going to buy a stock and sell calls on a share-for-share basis. The covered call seller has the obligation to sell the stock if it's assigned at the agreed upon price, which is the strike, up to and until the expiration date. In exchange, the covered call seller receives a premium. The covered call seller has the entire downside risk of the underlying security minus the premium. The upside potential is limited to the premium received. Now, before I go with the covered calls and put protected cash, I want to show on the broker, the long call, buy, sell, and the short of them, because it's going to be much easier to understand and serve as a good basis before I go, into more advanced parts like is the covered call or cash protected put. So we are going to go in the broker, in the interactive broker, which is what I'm using, for the demo of this strategy. Initially, we have a lot of values here that they may look very weird because we are not used with them. However, we are going to focus for now step by step on what's matter for us. So in this case, we are going to take SPI, and we are going to take, for example, let's take May 20 as an expiry date. So we have 45 days from now. Let's assume, for example, the price, we believe the price is going to be above 450 in 45 days. So for this, we go on the calls and we put a call entry. In this case, you can see we are going to pay $15.24 for the premium. This is going to be what we pay for the premium. If we go on the profile, we can see in this case that the maximum that we are going to lose is going to be this premium. It's always going to be this value. In this case, it's 1.5 thousand. Because if you actually take it, you can see it's the value that we can pay for this one, which is going to be more or less $1.5 thousand or 1.347 euros. And we have to multiply it because we take this one, it's the price of the contract, and we multiply by 100. So it's going to be the maximum that we are going to lose. You can see no matter how you go below 450, we are going to lose this value. However, you can see that once we start reaching and growing from 450, we are going to start to take profits. Our break-even point in this case is going to be 465 because we pay $15 per premium, so 465. The strike price 450. So if in 20 May the asset of SPI price is going to be 465, we are going to end up in break even. Any other value of upwards of 465, like for example 500, in this case going to be a benefit for us. You can see that if we would go 500, if we take 500 minus 465, it's going to be more or less 35. And if we multiply it by 100, you can see from where it's coming 3.6K, which is $3.6 thousand. If the price go even higher, you can see our profit is going to be even higher because it's 550 minus 465, and that's from where these values are coming. So you can see that our gain return is infinite. while the loss is always defined. Now let's do the same. Let's believe you. Now we say that, oh, you see, actually I believe that on 450 the price is going to be below it. So for it, we're going to buy a put instead right now. So we go on the profile and we can see now the price that we pay for it, it's $8. Yeah, we paid us. So we can see that we would pay $8. So you can see that if from 450 downwards, the maximum we are going to be losing is going to be these $8 per share, or in this case $800 in total. Our break-even point is going to be 450 minus 8, which is going to be 442. More or less around here, you can see it's going to be our break-even price, and everything below this is going to be a profit for us. If the price is going to finish on 400, we can gain a $4,000 profit, because it's going to be 4,000 minus the strike point that we have, which is going to be 450, but we have to calculate as well the premium, so that's from where the 4.2 is going to come for us of the benefit. So you can see that as well, our profit in this case is unlimited, while the risk is always defined. Now let's change these scenarios, and instead of this, now let's be the sellers. So you believe actually that no, it's going to be bullish. So because you believe it's going to be bullish, we are going to take sell put. We are going to sell this put actually. So we go on 450. But then you can see here that the maximum that we can win is going to be the premium, which in this case is going to be the $8 that the buyer previously paid us. You can see we are always going to win this if the price is going to be above 450. Our break-even point is going to be 442, because everything above this is going to be a profit for us, and everything below 442 is going to be a loss for us. So we can see in this case all this gain, like for example on 400, the gain of $4,000 for the buyer, it can be a lose for us, you know. So we can lose $4,000 while the buyer can buy, while the buyer can receive this $4,000. But yeah, now you might ask me, yeah man, but you see, why the fuck would I sell a short option if I can lose so much money? But don't you worry, I'm going to explain full in detail this one in the advanced lesson, and I'm going to make you understand that this is actually our edge. But yeah, I'm not going to enter into details into this right now. Let's see the same scenario like we saw for the short, but in this case for the call. So the same stuff for the call. Let's assume the same, that we believe that the price is going to be below 450, while the buyer of the call believes that the price is going to be above 450. So in this case, the same stuff. You can see that everything above 450. Oh, wait. Wait a moment. So if I sell a call, I sell 450. There we go. It was not actualized, so I was like, something was wrong going. Come on. There we go. So you can see that everything below 450 is going to give us the $1,500, which is going to be actually the premium that the buyer is paying. And everything above 450, like for example in the case of 500, we can see that we will end up losing almost 3.5k, because 3.5k it's 500 minus our strike price of 450, which is going to be 50, but at the same time to this we have to discount what we receive for the premium, which is 15, so it's going to be 35 per share or $3.5 thousand. So yeah, the same thing for the seller. We can see that our return is limited always on the seller part. We can always win the maximum from the premium, but our loss is infinite. And if we take the same, for example, in this case, we are going to put a buy. You can see that our loss, it's always defined, while the gain is always infinite. Oh, yeah. I hope by seeing the example, it's going to be much easier to assimilate the concepts, of buying and selling a call or a put. Let's go back to the presentation. So yeah. Now, let's assume we are going to do a covered call. So in this case, we are going to buy a stock and sell a call for the share. We are going to sell this call to hedge us in case the things are going to go sideways. So if you believe as well, like I said, you are neutral to a little bit bullish to the stock, it's going to increase the amount from the premium. It's going to increase the income by the amount of the premium we receive minus commissions, and as well it's going to reduce slightly the risk of the stock price by the amount of the premium. So yeah, the operation we are going to long 100 shares, $92 per share. So we are going to have a cost of $9.2 thousand, and we are going to sell one call for $1 for 95. So in this case, you can see if the price go to 100, we are going to receive the $8 from the stock, but we are going to lose $4 from the put. The call is going to be on 95, so everything about 95 is going to be a loss from the call minus the premium, so that's from where this $4 is came, while this 8 is coming 100 minus 92. So in this case, we will end up with a profit of 4. However, as I said, if you are slightly bullish or side market, you can see that, for example, the 95 is going to be our sweet spot. From 92 to 95 is going to be our sweet spot. So in this case, let's assume, for example, on 95, we can take the $3 from the stock, but also we can collect the premium. So in this case, we are going to collect the same $4, like it would be on 100. But yeah, if you can see that when the price is going to go downwards below 95, which is our sell call price, we are always going to receive $1. However, the stock from the loss is going to be limited, because it's going to be the current value minus the 92 that we bought initially. But yeah, we can see that this is how it hedges. And in the case we are slightly bullish, or you can see we have a kind of side market to slightly bullish, it can protect us to take the benefits from the both sides. And here we can see it as well with the graph, how everything after 95 is going to be linear. We are never going to take more than $4. But at the same time, the loss, you can see that it's always decreased by 1 in this case from the call sell. So now we have the strategy. We have to understand when buy to close, when to roll, and to let it expire. For this, the second strategy, which I'm going to speak about, is going to be how to sell a cash secured put. So selling a put and simultaneously put a margin aside, to fulfill the obligation if it's going to happen. So the cash secured put seller has an obligation to buy the stock at strike until expiration. The profit potential limited, as you saw in the broker, it's the one received from the premium. There is an infinite risk downside, and the amount of cash necessary to cover the obligation is required always. So yeah, we have to target a buying price, and we are going to receive an income and an interest on cash for this. How it works? We have $9,000 in cash and in a stock, and we have this QRS stock trading at $92. As well, we are neutral to slightly bullish, and we believe that the market is going to be slightly bullish or neutral. So for this, we are going to sell 190 put for $1, but we will have to deposit the 9,000 as an obligation. Why this 9,000? Imagine, for example, in this case, the price of this put is going to go below 90. Well, it's going to be 85 or something like that. Because of this, you are forced to buy at that price, so you will have to deposit this as a margin. Here you can see the results. You can see that everything which is going to be above 90 is going to result in a profit for us, and the profit is always going to be the premium that we receive, $1. However, the things are going to start messy after the price is going to be below us. So in this case, with 89, we are going to lose the premium. We are going to actually be in break even. But yeah, downwards, it's going to be unlimited. The price go to 0, you are going to lose 90 per share. So it's going to be $9,000. That's from where this value is coming. So that's the maximum loss that we can have. So you can see that the maximum that we can win is 100, the maximum that we can lose is 9,000. It's awful risk reward ratio, honestly, but don't worry, in the advanced lesson I will make you understand this and explain what is the edge and how to properly use it. And also, I didn't enter into it right now. Yeah, we can see here as well in the graph that everything about 90 ends up with us with a profit of 1. However, everything below is going to be unlimited risk. So yeah, we saw what it's like to be selling a covered call. We can also sell cash secured call as well. It's going to be the opposite of the put one, and we can see that in general the maximum loss it's unlimited, while the potential is always limited by the premium which we are going to receive. So, now, before you place a trade, consider buying or selling one call is the equivalent of trading 100 shares of the stock, but this is for the put as well. Always remember that we have to multiply by 100 that premium that we see here. Like I said previously as well, consider how much risk you are comfortable taking and always be aware of the position size. So yeah, long options, you sell it. Short options, you buy it back. Long options, you exercise it. Short options, you fulfill that obligation if you are going to be assigned. Long options or short option, you can both let it expire. And then we see the glossary. So yeah, more information you can find on the website traderlife.com, and if you have a question or something, my email, my Telegram, contact at traderlife, and softskills21, my Telegram ID. So yeah, I hope you enjoy it and see you on the next lesson. Bye bye.